Hello and welcome to Absolute Trust Talk. This is our live streaming podcast here at Absolute Trust Council, and I am Kirsten Howe, the host today. I'm so glad to have you here. We always have a lot of interesting content for you, and today is no exception. If you or someone you know, like many of our clients, own investment real estate, and you've thought about selling it, but the idea of paying all that tax on the sale just makes you cringe, we might have something for you to think about in this episode. The Internal Revenue Code Section 1031, don't worry, you don't have to memorize that, allows sellers of real estate to defer the tax on their sale by purchasing a new property in some circumstances, and that's what we're going to talk about today. You may have heard of these transactions, colloquially we call them 1031 exchanges, and that's what we're going to talk about with an expert. Just to remind those of you who are watching us live, if you have questions for our guest today, go ahead and type them into the comment section and we will address them before we sign off today. So, without further ado, my expert, Teresa Flugel, is an executive vice president at Chicago Deferred Exchange Company, LLC. They are a national provider of qualified intermediary services for transactions just like what we're going to talk about today. Since 2004, Teresa has held the Certified Exchange Specialist designation, so she really knows what she's talking about. And she's got more than 25 years of experience that she brings to this. She is the expert, absolutely, in this field. She works with attorneys, she works with accountants, commercial real estate professionals, and directly with investors who are trying to defer the tax on a real estate transaction. And she is an expert not only in the plain vanilla 1031 exchanges, but some of the more exotic varieties or sub-varieties like forward delayed exchanges, reverse exchanges, build to suit exchanges, and we'll touch, I think, a little bit on some of those as we go along. She loves to teach. She is a frequent instructor of accredited 1031 courses for law firms, for accounting firms, and also national trade organizations like CREW, CCIM, SIOR, Federation of Exchange Accommodators, and Provisors, which is one of my organizations. So thank you, Teresa, so much for being here. This is a topic I've wanted to cover for a long time, and you are the only one I would think of to do it. So thank you.
Thank you, Kirsten. I appreciate being here today and joining you and your audience to talk about 1031s.
Great. Okay, well, let's start real simple. What is a 1031 exchange?
Sure. Well, Internal Revenue Code Section 1031 has been out there since 1921. So it's over 100 years.
I didn't know investors,
that. Oh, okay. 100 years, yeah. So fortunately, real estate investors can still defer the capital gains tax on the sale of their investment property. So our role is the qualified intermediary, and we help guide clients by answering their questions, walking them through the process, working with them on the documentations and all the requirements in order for them to be able to defer the tax.
Okay, so just kind of really basic. If you bought a piece of property, you paid $100,000 for it, and now you want to sell it, but it's worth $200,000. That is what we call capital gain. There's $100,000 of profit that you're going to make, and the United States government, as well as the state of California, they like to tax profit. So what we are talking about is there's a way to defer paying that tax. In this kind of a transaction, you're not going to have to pay the tax right now when you sell this property. Am I saying it right?
You are. So, you are definitely. So,
okay. So how does it work? To kind of walk us through what that looks like.
Absolutely. So many investors that enter into 1031 exchanges have never done one before. They may have never heard of it before. And they will either learn about it from their attorney, their CPA, or perhaps even their, broker that's helping them sell the property, or even the escrow officer at the title company. But in general, when you own any type of investment property, and you go to sell that property and it's not your primary residence, we're not talking about the primary residence that you live in, we're strictly talking about investment property. You come to a decision and you have to either decide that you're going to pay the capital gains tax that you mentioned, or you're going to enter into a 1031 exchange. So to give you an idea on that scenario, you purchase property for 100, you're selling for 2, just the simple calculation, you've got $100,000 gain. And if we look at current tax rates today, you have 20% for federal, 12.3 for the state of California if your property's here, and then you have the 3.8 affordable health care tax as well. Plus, you may have some depreciation recapture tax of 25%. I usually tell folks, in general, give or take, it's about a third. So if you had $100,000 gain, you'd probably be paying $30,000, $35,000 in tax, which might be okay. Or you decide, hey, I want to learn more about the 1031, and that's what we're going to talk about today.
Okay. So let's say I'm an owner of real estate, and I think this is probably a good idea for me. What are the rules? What is the timing? What does the process look like? What am I going to expect to happen?
Sure. So in talking with you, like you would be one of our clients that gives us a call, you're like, I'm doing this. I'm not sure what I'm doing. How does it work? A couple questions we would ask you. I'd want to make sure that, number one, your property is going to qualify for 1031. So we'd want to know how long you've owned the property. How do you currently, hold title to the property? Are you using it for the intent of having it for investment property? That's how you're reporting it on your tax return. If you want 100% tax deferral, there's 2 general requirements, which we can talk about, different type of property, like kind of property you can buy. We're going to say, have you talked to your CPA? Do you know what your gain is? In our role, we can't provide specific tax or legal advice. So we always want clients, because we don't know if you exchanged into it. You may have some losses that might offset the gain. We certainly want to make sure that it makes sense for you to do the 1031.
Okay, that's it. So that is like an important, really very preliminary step. Talk to your tax person and get all of your details squared away so they can tell you, yeah, this could be a good thing for you. You could qualify.
Yep. And I'm happy, we're always happy to talk to people when they're thinking about selling, because sometimes you can line up your ducks in a row and get those questions answered, versus I'm closing tomorrow, and then you're like, wow, okay.
Oh, okay. This is a problem. Okay. So assuming that, well, let me ask you this.
Mhm.
You say investment property and you have to be reporting it as an investment property. So can a vacation home be an investment property?
That's a very good question. So I'll talk about vacation homes and second homes quickly here. So your primary residence that you actually live in does not qualify. If
Right.
you're reporting property truly as a second homes don't qualify for 1031.
Okay.
So you got to be careful. And if you have a vacation home that is truly held for the intent of holding it for investment purposes, and you could use it 14 days or less a year, you'd want to show some rental income is what CPAs like to see. So, vacant land qualifies. Vacant land doesn't produce any income. So clients are happy to know that they can exchange into, single family rentals, condos, apartments, office, commercial, industrial, retail, self-storage, warehouse, tenancy in common with other owners, anywhere in the US. So it's like kind of sounds very specific, but it's actually very broad. You just have to acquire the property with the intent of holding it for investment purposes. So I think how you word it and how you're communicating what the property is, what it's used for with your CPA is really important.
Okay. So the basic idea is it's got to be a like kind exchange, and like kind could mean as long as it's the selling property fits into the category and the purchasing property fits into the category. It doesn't have to be, for example, a single family residential rental property exchange for another single family resident. You could exchange it for a duplex. You could exchange it for a multifamily unit. You know, it doesn't have to be exactly the same.
Correct.
Okay. Perfect. Now I'm learning so much today. Okay. So we've done the preliminary. We talked to the CPA and the CPA says, yep, let's take a look at this. Let's see what the next step is. So what happens? What do we have to do now?
So in general, when we think about, prior to setting up the 1031 exchange, we could talk a little bit about that. So we need to be involved as a qualified intermediary before you close escrow on the sale property. So if you are in contract, open an escrow at the title company, at some point, we as the intermediary, as the professional service provider, come into that transaction. Now, either you call us as the seller, or you have your attorney call us, or and have us set up the exchange. It's critical, because if you have constructive receipt of the funds, it's too late to do a 1031 exchange. And that happens more than you would think it does. It just happened this week. Somebody called, they had 2 properties, and we're talking about the second property. And then they were like, well, we closed last week on the other property. I'm like, so it's like, so you've got to be really careful on that part, because what happens is, we come into that, coordinate documents for signature, working with your attorney and your escrow officer. So that way the proceeds come into the 1031 exchange account. So you've officially decided you're going to do a 1031 exchange. That's what's going to start this clock ticking that we're going to talk about with the specific requirements. There's a lot of black and white and a lot of gray area. Okay.
So what's really, really important is that you cannot, as the seller, receive the money, whether we're talking about you receive it yourself or it comes into the escrow. It's got to go to the intermediary, which is you. Okay. And if the money's already come into the escrow that the buyer and seller set up, then it's too late.
If the money goes to the seller taxpayer,
okay, it can stay in that escrow and you can come in then.
Well, it just, we need to come in at closing, because all the documentation has to be signed. So even if they've closed escrow and the transaction's recorded, it's going to be too late. It has to be, we have to be right in there. So,
Okay. So you then, your company receives the funds in
and
your
then what
own
happens?
account.
Okay.
Yeah.
So
to go ahead and
okay. You know how I am. I turn into a presentation. So so we receive your funds. We play at our company. At Chicago Deferred, we place them in a separate qualified trust account. So we assure people of the security and the safety of their funds. Because you're using a third-party intermediary, right? So once we receive your proceeds, now we send you verification of funds received with the critical dates. So you have a total of 180 calendar days to purchase new property. You have to identify the property on the form that we provide to you, indicating what property it is you're going to purchase. And then you have to be able to close, on property that you identified within the 180 days. So the 45 is part of the 180 days. So we can talk about the timing, we can talk about the identification rules, and we can also talk about what if I want to keep some of the cash, or how do I do 100% tax deferral, or what if I want to do this, or so.
Okay. So, well, let's talk about the various deadlines. So you said 45 days from close of the sale escrow.
Yep. So the next day, we receive funds at closing. The next day is what starts the official clock ticking. So it's a total of 180 calendar days. Every single day counts. Weekends, holidays.
Oh,
so
that is such a good, important point. Yes.
It is a very good, important point. Sunday does not roll over to Monday. No, that doesn't happen. It doesn't matter that it was New Year's Day. It doesn't matter that you're on vacation.
Yeah.
So you have 45 calendar days, which can go by very fast. 45 calendar days to identify property. You don't have to be in contract during the 45 days. But you do have to be able to close on something that you identified within the 180 days to have a valid exchange. So, when we talk to clients about this, when your money comes in, okay, you have to keep in mind that money is going to be locked up in the exchange account the initial 45 calendar days. It can go towards deposits. It can go towards purchase of property. You don't have to wait the full 180 days to close on your property or wait the 45 days to close on the purchase. You could close on your sale, August 1st. You could close on your purchase, the next day. So you can kind of get both transactions moving at the same time, because that 45-day window goes by fast and there's zero extensions.
That's
it does not matter. I mean,
the
unless
IRS doesn't care. Yeah.
No.
Okay. And okay, so you've got to identify a property within 45 days. Can you identify more than one property in that 45 days? And then you end up closing on one of the 3 that you identified?
Yep. So you can change your mind as many times as you want during the 45 days. Sometimes people might just revoke the whole identification and then they would just end up paying the tax as they normally would have if they did not do an exchange, and we would release funds on day 46. So what's important to keep in mind when you're going to be identifying property is, if you want 100% tax deferral, there's 2 requirements. You can certainly do a partial exchange. If the first requirement is you want to buy property that's going to be equal or greater than the $200 that we initially talked about. So because you're selling for $200, you need to buy for $200. Okay. So with that being said, you can deduct broker commissions and closing costs from that amount. You cannot deduct any loan finance, cost from that amount, but you can definitely deduct broker commissions and, title escrow, exchange fees from, recording fees from that. So if you came in at like 180, you might be okay if you sold for 2 and, come in at 180. So that's the first requirement. And I say that in clarity like that because many clients think they only need to reinvest their net equity or their net proceeds. So if you sold for 100 and you're buying, you purchased for 100, you're selling for 200. And let's just say you have $50 worth of debt on this property, right? So when you sell for 2, we're holding $150, right?
Right.
So now when you go to buy property, Kirsten, you're gonna want to buy for that 2. You can deduct broker commissions, and you have 150 with us. Somehow you're going to make up that other 50 because that 50 was paid off through escrow on the sale, right? So now we're like, you can use new financing or cash out of pocket, or you would have some taxable boot. And that's kind of what always surprising to people sometimes, because in today's market, people have gotten a lot of unsolicited offers and they're getting offers way beyond their wildest dreams, right? They're like, wow, I didn't know my property was worth that much. And then they're like, well, now wait a minute, I got to go buy property. That's where they're like, they weren't anticipating that with the 1031. So.
Okay. And so if they do decide, well, I do want to buy another property, but I can't buy one that's greater than the amount that I'm supposed to buy it. Is that a situation where you can just get a partial 1031? Is that what you're talking about?
You can. Yeah. So you can buy up as much as you want. So if you were selling for 2, you could buy for 2, 3, 4, 5, $1 million, whatever you want. If you buy property of lesser value, or you take some cash out, have cash left over, or if you overfund your loan when you go get new property and say, I need another $50 here for whatever, I want to go on vacation, you're going to have some taxable boot. So those are kind of we're always talking to clients about that. It's like 100% tax deferral, talk to your CPA, but you can certainly do a partial, to your point. Yes.
Okay. So you identify the new property within 45 days, and the escrow on whatever new property you want to qualify for the 1031 has got to close 180 days.
By day 180.
Yeah. Which is not 45 plus 180. It's just 180.
Correct. And if you're unable to close, we would release your money on day 181 at the end of the exchange period. So this is what clients don't like, is when you enter into the 45 days, your money's locked up for 45 days. The critical point of going back to identifying how many properties, you can identify up to 3 properties, any fair market value anywhere in the US. Change your mind as much as you want during the 45 days. that's the most common way of identifying property. If clients want more than 3, the IRS has a rule out there that's known as the 200% rule. And basically what they're stating is they don't want somebody to go out and identify 50 or 100 or 250 properties. They're like, okay, investors, 3, any price you want. Or if you want more than 3, if you want 4 or 5 or 15 properties, which is not uncommon, you cannot go over 2 times the value of what you sold. So in your instance, you sold for 200, you could do 3 of any value. As soon as you identified a 4th property, then you couldn't go over $400.
Got it.
Does that make sense? So, and we do see that a lot of people identify the, I don't think I mentioned it, the Delaware Statutory Trust, DSTs. It's an undivided fractional interest in a larger property. And so they get little slivers of tenancy and common interest, and they'll want quite a few of them sometimes. So it just depends on what works for investors. We say, do all your due diligence. In our role, we do not provide them with specific tax or legal advice. We're not their CPA, we're not their attorney. We're here to make sure that you're doing everything in accordance with the IRS rules. And we will tell you, yes, this works. No, this doesn't work. Or we can talk about this. It's a risk tolerance issue, which comes down to you and your advisor's risk tolerance if you're wanting to do something that's not quite black and white.
Right. Which, there's certainly a lot of that in the tax code. Okay. So can you sell 2 properties and purchase 1 in the 1031 exchange, or vice versa? You're selling 1 property and you purchase 2, or?
Sure. So, a lot of the reasons, we didn't really talk about this yet. Reasons why people do 1031 exchanges is, number 1, they want to defer the tax. They may want to diversify their portfolio. They may want to go from multiple to 1 or from 1 to multiple. They may be looking for greater cash flow, greater appreciation, something they can retire into, less hands-on management, but at the end of the day, it really ties down to the estate planning, right? Because when you do your trust and your estate planning, then hopefully your heirs, they inherit that property and they get the stepped up basis, which is why it is so critical that people, take a look at their whole portfolio. When we see folks that are, holding titles individuals, it's always kind of like, you're selling either, investment property, you've got a portfolio, you've got commercial property in there, you have a trust attorney, are you working sure with your estate planning? And, those are kind of all things that you kind of see that, and clients always appreciate learning more about that and how all this kind of ties together within our, professional worlds, right? But you can go from multiple to 1, to answer your question real quick.
Okay.
So the timeline is going to start when the first one closes. So depending on how you can line those up is how it's, you're always going to work with the first timeline going forward to try to get the second one to sell so that you can use proceeds from both into 1.
Okay. All right. So you can go from multiple to 1, and can you do it in the reverse from 1 to multiple?
Yes. Mm-hmm.
And so in my scenario, if I'm selling for 200, can I buy 2 $100 properties?
Yes.
Okay. Got it. Okay. I got to make this simple for myself. I'm sorry.
No, most people, most people have never done a 1031, and they may only do 1 or 2 in their lifetime. And, we work with a lot of high net worth individuals, companies, corporations, REITs all across the country. Every situation is completely different. Everybody, if they're a business owner or real estate people or not, it's not something people do every day. It's all we do, is all I do all day long, every day. But it's not something you do. People kind of heard about it, know a little bit, but not to this level of detail.
Yeah.
So it's good that we just.
Yeah. And the details are super important because there are a lot of stuff in there that the IRS is not forgiving on. If you miss it, you miss it. And you just don't get, then you're paying that 35% tax, which is painful. Okay. So you mentioned Delaware Statutory Trust, which is like a real estate-ish product, so somebody could, in theory, use a 1031 exchange to get out of owning real estate directly and get into owning it in that kind of arrangement. Am I correct? Okay.
You are. There's, a partnership interest doesn't qualify. So a partnership, that's why we really make the distinction when our clients are talking about, I want to invest in this partnership or this REIT or this LLC. And we're like, okay, for 1031 purposes, you have to be able to, number one, hold title the same way, take title the same way how you hold title on your sale property. But you also need to be able to take, tenancy in common, undivided fractional interest of real estate in order for it to qualify for 1031. So you couldn't exchange into like someone's LLC and give them cash. That doesn't work. They have to be able to give you a slice of the pie. And so the Delaware Statutory Trust is different in the way of, they may have a large, industrial building or a large retail building or a large apartment building. And there's providers out there that's all they specialize in. It's not what we do, but they would tell you all that, do all the due diligence, all the ins and outs. Here's your returns, this is how this works. And so, it has nothing to do with us. I mean, you're exchanging into lifetime real estate that's called the Delaware Statutory Trust, which is a DST, which is like a sliver of investment that you get a return on. And, a lot of times people will use them as a backup, just in case their other two real estate properties didn't work out. And they really want to have passive income. So we see people that go from apartments, not apartments, but houses into apartments. And then the apartment people move into triple net properties, single tenant properties. And then owner users sometimes go that way as well. They're like, we're tired of our business. We're tired of this. We just want some income. We don't want to worry about it, and then the DSTs kind of go that way. And then, sometimes they will convert into an actual REIT because you cannot exchange directly into a REIT because that's an interest in a partnership and that doesn't qualify. So you kind of have to do a step to get there through the DST. Okay. Is my understanding, and I'm not an expert on DSTs. I know enough in their space to know, enough to know not to talk anymore about it.
This is not a Delaware Statutory Trust.
No, we're strictly the third party intermediary that's telling you
just just kind of pointing out there are other ways to go, but in a 1031 exchange, so you just did mention LLCs, entities can also use 1031 exchanges. Like if I have a client who owns a property in an LLC, can that LLC use you to sell that one and buy a new one?
So they have to sell real estate. So it all starts with, they have a buyer, they have a contract, they're selling real property. If they hold title in an LLC, they're either going to hold title as an individual, it might be in their trust, their living trust, it might be in an LLC and they're filing a partnership return. So whatever entity of how they hold legal title to the property, we get a copy of the contract, we get a copy of the title report, and how they're reporting it on their tax return. The IRS wants to see that same entity acquire new property.
As the buyer. Yeah.
Yeah. The buyer. Okay. The exchange.
But so as long as the seller and buyer of new property are the same, it's good. It could be an individual, it could be an LLC.
Mm-hmm.
Okay. That's cool. Now, and you said, just let's focus a tiny bit more on the relative values. The selling property in my scenario, 200 is the actual amount the seller is, or the buyer is paying my seller, 200. And from that, we are allowed to deduct the costs of that sale. So let's say
commissions and closing costs. There's a revenue ruling out there from 1972 that we rely on that allows you to say what fees you can deduct if you're going to buy, to balance it out. But in general, it's always going to be equal or greater than what your sales price is. So if there's multiple sellers, then maybe you're selling property for $1 million with 4 of your siblings, right? So then you each have 200,000.
Okay.
So then it's
all right.
based on what your percentage of
What your
ownership is
percentage.
on the sale property going forward. And then
Okay.
your proceeds that come into the exchange after the close of escrow, we're coordinating documents on the sale. You review the estimated closing statement. We review the estimated closing statement. Funds come into the exchange. We send you verification of funds received with those critical dates. You start identifying property. You're looking for property that's going to be equal or greater. Funds in the exchange go towards deposits, towards purchase of the property. So then we're going to be working with you on the purchase side as well, all over the country, with that title company attorney on that side. So we're with you all the way through, the exchange from the sale, answering all the questions, holding your hand, going through the process all the way until the end of the exchange, till it's complete.
Okay. All right. So now I'm going to ask you this question. I know from talking to you, and I didn't know this before I talked to you, but it is also possible, I think, perhaps less common, for the client to buy the new property first and then sell the old one. That's not the standard way, but that happens too.
Yes. So we do
Is
two
that-
things. We either do a forward delayed exchange where you're going to sell property, funds come into the exchange, you identify, you close escrow, you're done with the forward exchange. Or we do reverse exchanges. Revenue procedure came out in 2000, and it can be reverse exchanges or really a parking arrangement. So the first thing I talk to clients about this when they call and say, I still have a tenant in my property. I got to clean it up a little bit, but I found the property I want to buy.
Really great.
And so they're all excited about this. And, and so they can certainly purchase the property first. But again, we have to be involved before they close escrow on that property, because if they just go buy it, it can't be part of the exchange. You can't call and say, oh, I bought a property last week, I want to do an exchange. It's like, no, we have to be involved. Whenever you're buying and selling, you have to have the intermediary involved. So we take on the role as an exchange accommodation title holder. So when you think about that, you haven't sold your property yet, right? For two,
Right.
But let's just say you found something, for two that you want to buy, and you're like,
you can't
I
pass
gotta
it
have
up.
this property. So we're like, okay, how are you going to come up with financing? Do you have cash out of pocket, or do you have lender financing? And you'll be like, you might just say, yeah, I've got the cash, I'll upfront it. Which sometimes, happens a lot. Other times it's like, well, I haven't sold my property yet. I don't have that kind of cash around. So,
money.
if we're either going to work directly with you as the purchaser or your lender, and we do a conference call with your lender, because we need to talk with the lender, because we now, as the intermediary accommodator, are going to take legal title to that purchase property at the close of escrow. That's all we're going to do. We're going to come into that and just imagine us parking that property in the exchange. So we set up an LLC, because we have to park the property in an LLC. We prepare a lease agreement back to you, Kirsten. So you fully operate, manage, you can go put a tenant in there, whatever you want to do. But we're just going to hold that property up to 180 days while you sell your existing property. So you still have to identify the property you're going to sell. Hopefully you sell that property within 180 days. Once you sell that property, we're working with you, with your closing agent on that side. So when the proceeds come in, the proceeds will either pay you back the money that you upfronted, or they would pay back the lender or pay down the loan. So it's critical that you talk to your lender. You want to make sure you don't have any prepayment penalties in there if you're going to be paying off the loan sooner than maybe what they originally thought. Those types of things we kind of talk out, and we're getting into more details about that. But it definitely reverse exchanges are popular. We do a lot of them, and we do them, a lot of your large institutional REITs, that's the way they operate, because they're like, we want to go have the time to do the due diligence and negotiate, and park that property, because we've got several other properties we might be able to sell. So,
right.
But we do them a lot for folks, especially, when you think about owner users that have a business, and they're like, how do I move out of here when I got my staff and our equipment? And so if you think about going and buying the property first,
and then
you move everybody over there, and all of that, and then you can sell your existing property.
Yeah, I mean, that's so much easier on the people who are occupying the property to,
Yeah.
okay, I already have a place to move. Now I can sell this old one. But
Mhm.
okay, that's good to know that you can still do that, even though you found the new property first.
Yeah.
Okay.
And a lot of times, I mean, there's quite a few people that they're not sure how it's going to work because they have their property on the market and they're like, well, and they might be able to negotiate extensions because if you think about it, everybody that's selling investment real estate is subject to this tax again, right? So every
Yeah.
person that you're looking at, it's like, well, maybe they're going to be happy to know that I want to identify and purchase their property because now they can go figure out if they're going to pay the tax or they're going to do a 1031. So it's kind of like a big domino effect sometimes.
Right. Yeah.
But when you throw in the commercial or the residential component with primary residence, it throws a wrench in there because you're not, when people want to buy single families, a lot of single families are people's homes, right? That's where they live. So they're like, hey, I want to close right now because I'm moving. And that's where it can get, a little bit like, people are not going to be as willing to do extensions when it's on that side of it. And we saw, if that makes sense.
Yeah, that's a good point. Okay. So I think that really the lesson here today is it's a great way to go for the right situation, and it's complicated. It's complicated. Um, okay, so I'm going to turn to our audience questions because we do have a few, and let me scroll to the top. I saw one right off the bat as soon as we started talking. Are there restrictions to doing a cash out refi after a 1031 on a mixed use? That's the exact question.
Yeah, so that's a very good question because we wouldn't recommend that a client do a refinance in front of doing an exchange because it looked like your intent was to pull the cash out. But once you've completed the exchange as a separate transaction, you can refinance that property, put a loan on it, take cash out without it being subject to tax. So you don't want to overfund your loan initially and walk away with cash at the close of escrow because that would create taxable boot. It has to be a separate, isolated transaction. And risk tolerance on that, I mean, some people, known tax attorneys will say, oh, the next day is fine. Another tax attorney will say, wait 30 days.
Let's wait.
Wait a while here. And usually I say by the time people get through an exchange, they want a break and then they'll,
Okay. Fair. Yeah, fair enough. Okay. Scrolling through, looking for our questions. Okay. So, is there a limit on the amount of capital gain you can defer?
There's not. I mean, you keep deferring and deferring and deferring until you either, pay the tax, right? Because the ball is rolling forward and gets bigger and bigger. So you either pay the tax or you set up your estate planning and you start working with your family, to determine what type of properties that they might be most interested in. We do see people that do that, because it's like, well, I kind of want this, but, maybe they need to buy a building or residence for.
Okay. So maybe kind of related to that is another question here. Is there a plan B or backup plan for a failed 1031 exchange?
Well,
probably depends on how it
fails. If you fail an exchange by, not identifying property, by day 45. So, a couple things with that. So, I mean, there is something out there that's called, not cost segregation. It's the opportunity zones, right? So the opportunity zone is the same timeline as an exchange. It's 180 calendar days. Okay. So sometimes people are like, I'm going to invest in an opportunity zone to defer the tax, or I'm going to do a 1031 exchange. It's difficult. The only way you could do both if you have a failed exchange is if you enter into the 1031, we have your funds for 45 days. You couldn't find anything. We release your funds on day 46. You've still got that remaining, 135 days to work with an opportunity zone. But advanced planning, you need to figure that out before, kind of like, start doing due diligence on that if you're going to go that route. If you have a failed exchange at the very end and you're, day 181 and we have cash left over because you're not able to acquire your remaining, or acquire your purchase property, then you're failed. I mean, there's really not, you'd have to talk to your CPA, that's where the tax advisors come in. If there's anything you can do, that's where in our world, you're out of our space. You got to move down to the next door.
That's when you start harvesting losses so you can offset. Okay, that is a great question. And I had not at all anticipated that you would have a positively framed answer. So that's great. Okay. How often or how many times can one person do a 1031?
Right now, there's no limit. I mean, you can do as many exchanges in a year as you want. So if you had, 5, 10, 15 properties, you could sell all of them. So they don't have a limit on how many exchanges you can do or the length of time between the two exchanges. Okay. We do know with every new administration, there's changes. There's always a threat of a change or a change. In 2017, they took away personal property. We used to do a lot of personal property exchanges, which was rental car fleets, artwork, collectibles, farm equipment, aircraft, kind of cool stuff, right? And
they completely got rid of that?
Completely. And so that's where you don't always know. We definitely are very, active with our trade association and, on top of all of those things.
Yeah. Wow. I didn't know that was a thing. The personal property 1031. That's fascinating.
Businesses, right? So people they did dry cleaner for dry cleaner or something or gas station for gas station. A lot of people would want to exchange a business and go into real estate. And, you couldn't do that.
It's got to be like kind.
Yeah. You couldn't do that before, but you can't, now you can't even do
it. I can't do it at all. Yeah. I had no idea. I completely missed the boat on that. Okay. Well, it doesn't matter. Okay. Let me just double check and make sure I didn't miss any of the questions. I think that's it. Teresa, thank you so much. I learned so much and I realized that I only know less than 1/2% of what you know about this now, but thank you so much for sharing this with our audience. I really appreciate it.
Oh, thank you for having me, Kirsten.
You are most welcome. Okay. And thank you all for being here today. We always like audience while we're doing this live, and we had some really good questions. So thank you very much. I look forward to connecting with you next time.
Thank you for joining us today for another episode of Absolute Trust Talk Live. If you enjoyed listening in, then don't forget to subscribe. You can find us on Apple Podcasts or wherever you may listen by searching Absolute Trust Talk. While you're there, we would also love for you to leave us a review. And then why not share your favorite episodes with family, friends, or colleagues too? You can find all of our shows and corresponding show notes by visiting absolutetrustcouncil.com. You'll also find a variety of other free resources, including our ebooks, videos, blogs, presentations, and more. If you need help with your estate planning or administration, we also offer a free discovery call to help get the process started. You can find more information on booking your session by visiting absolutetrustcouncil.com/scheduling. Don't forget to keep an eye out for our next live episode in 2 weeks. If you join us for the broadcast, you can submit questions during the show. But if not, don't worry. You can always get in touch with us by sending a quick message to info@absolutetrustcouncil.com. Thanks again for listening. We'll see you soon.